Is the U.S. housing market going to crash the markets? If Trump wins the election, could his tariffs spark a global recession? Which were the best performing sectors and assets last week, and what should you be paying attention to this week? Welcome to the Daily Show, where we take a look at the latest economic news, market data, and stock market updates. Big earnings are coming this week, so make sure to stay tuned for more. First up, existing home sales are on track for their worst year since 1995. The housing market's hitting a rough patch thanks to high mortgage rates and sky-high prices. Sales of existing homes dipped by 1% from August to September, hitting an annualized rate of 3.84 million units. That's the worst we've seen in almost 30 years. Why? Simple: new mortgages above 6% and a median home price of around $404,500 have many potential buyers backing out. The National Association of Realtors thinks relief could be on the way. Mortgage rates might ease next year, and spring tends to be the peak buying season as families like to move between school years. On a more positive note, NVIDIA recently overtook Apple as the world's most valuable company, driven by skyrocketing demand for its AI chips. NVIDIA hit a market cap of $3.53 trillion, briefly edging out Apple, though it settled at $3.47 trillion. The October rally helped, boosted by OpenAI's recent new funding haul, which is pushing even more investment in AI. Apple's revenue growth is expected to hit about 5.5% year-over-year to $94.5 billion, while NVIDIA's is projected to jump 82% to $32.9 billion. For months, NVIDIA, Apple, and Microsoft have been close in valuation. NVIDIA's dominance in AI chips has set it apart, especially as more companies integrate AI into their operations. Apple is experiencing some challenges, like sluggish iPhone sales in China, while NVIDIA's stock has shot up nearly 190% this year. The AI wave may be hyped. This might be a bubble, but for now, NVIDIA's holding strong with more upside potential, according to Bank of America analysts. On another note, Christine Lagarde, president of the European Central Bank, warns that rising trade barriers could push inflation right back up, costing the global economy up to 9% of GDP in the worst-case scenario. Her remarks come just before the U.S. election, as former President Trump proposes very high tariffs on imports from China and other countries. A trade war, she said, quote, would make it more challenging for central banks to ensure price stability, end quote. A trade war could push up material costs, ultimately hiking prices for everyone. The latest Wall Street Journal survey shows economists expect Trump's policies to raise inflation, interest rates, and the federal budget deficit. Lagarde also highlighted that if new tariffs hit Eurozone exports, Europe's already slow growth could take a hit. The IMF estimates global real GDP growth will average around 3.2% in 2025, with only 1.2% in the EU, 2.2% in the US, and 4.2% in emerging markets. A severe trade war, with a possible 6 to 9% GDP hit, would drive us into a global recession. In short, a trade war and the rise of protectionism across the globe is a recipe for economic disaster and could bring inflation back now that it has cooled down. For the moment, though, markets are optimistic. Inflation expectations in the U.S. have cooled off, with the University of Michigan revising the one-year outlook to 2.7% in October 2024, the lowest since late 2020. This signals confidence in the Federal Reserve, with the five-year forecast steady at 3%, slightly down from last month. U.S. consumer sentiment climbed to 70.5 in October, hitting a six-month high, helped by lower interest rates improving conditions for durable goods. Political factors also influenced views. Republican confidence has ticked up as Trump's chances in the election have improved. Around 37% of S&P 500 companies have reported earnings so far, with average growth at 3.6% year-over-year. The leaders are the tech and communication companies, showing 16% and 11.5% growth, respectively. Energy, on the other hand, dropped a very significant 27.3%. The S&P forward PV ratio is sitting at 21.7, well above the 5-year average of 19.6 and the 10-year average of 18.1. IT has the highest forward 12-month P/E ratio, over 29, while energy is lowest, just below 14. Sentiment in the S&P 500 is at a 15-year high, but let's stay sharp and watch for warning signs. From the bull side, we can say that we have been in a bull market for 2 full years, and we have some interesting insights. The average length of bull markets that passed the 2-year mark is 8 years and an average gain of 288%. So far, the S&P has been up over 60% since October 2022. Fun fact, October 28th is, on average, the best day of the year for the S&P since 1950. I don't think this will happen this year given the uncertainties with the election, but still something interesting that Ryan Dietrich commented on X. Wall Street ended mixed on Friday. The Nasdaq climbed 0.56%, hitting new highs, while the Dow slipped 0.61% and the S&P barely moved. The Russell also lost nearly half a point. For the week, the Nasdaq edged up by 0.16%, boosted by Tesla's incredible 22% surge, but other indices recorded losses. The S&P dipped 0.96%, the Dow dropped 2.68%, and the Russell nearly 3%. Political uncertainties, geopolitical tensions in the Middle East, and speculation about the Federal Reserve slowing its rate cuts have kept investors cautious. Investors are digesting the latest economic data and gearing up for big tech earnings in the final stretch of October, all while the U.S. election looms. Bond yields are also making headlines, with the U.S. 10-year Treasury yield rising to 4.24%, driven by stronger-than-expected U.S. economic data and fiscal concerns regardless of who wins the upcoming elections. In general, last week was a great week for 10-year yields, with bond yields from other countries like Germany, France, and Italy going up over 4%. The Fear and Greed Index is at 59. This is a shift from the extreme levels of greed that we saw last week. So you could say that markets are cautiously optimistic and people are not feeling FOMO. Sector rotation shows that last week was mostly negative for stocks. The solar ETF stole the show and surged 4.31%, while consumer discretionary gained 0.65% and semiconductors 0.58%. However, home builders took a serious hit, falling over 7%, its worst week since June 2022, and metals and mining, materials, and gold miners fell more than 3%. On Friday, crude oil rose 2.27%, reaching $71.78 on geopolitical concerns, and natural gas climbed 1.51%. Gold also ticked up 0.5% to $2,747, as central banks are loading up on gold to guard against inflation and reduce dependence on the US dollar. In fact, gold has been the best-performing asset class so far in 2024, with an over 31% return, above the 23% of the S&P 500. Note that this doesn't include Bitcoin, which has seen a year-to-date return of over 58%. This week is a big one for the stock market, as 5 of the Magnificent 7 companies report their earnings. Alphabet reports on Tuesday after the stock market closes, Microsoft and Meta on Wednesday, and Apple and Amazon on Thursday. Other big names reporting this week are AMD, Intel, Pfizer, Exxon, and more. We also have some interesting economic data coming up, like the advanced GDP estimate for the US, core PCE, and non-farm payrolls. Please subscribe and hit the notification bell to stay tuned for daily updates. If you've made it this far, thank you, and see you tomorrow.